Hey folks, Dan Frio here with your real estate update for the first trading day of 2024. So welcome back. I know I took a couple days off and it was well needed, and I have some bags under my eyes because I had a great time on New Year's Eve. So my goal here is my name is Dan Frio. I do this report on a daily basis. The reason why I do this is onefold. I want to make sure you're educated on real estate. And we focus in on this channel on two different things. One, what's going on with the mortgage products? Because if you don't have the cash to buy a house, it's irrelevant to even start looking if you can't afford a house in this market. So one, we look at the mortgage piece of the equation as well as interest rates. And then the other facet of this is I want you to understand how real estate or how the housing market really works for value, how much the prices in your area are doing. You shouldn't be concerned what's happening in San Francisco if you live in Des Moines, Iowa. Okay, the reason being is if they see a decline in their market, are you going to see a decline in your market? Probably not, because the dynamics aren't the same. So my goal here is to educate you on the financing side and also how to make a prudent decision on if you should buy a house in 2024 or maybe continue to rent. How's your market? Is your market a strong buy market, or is it a market where you should maybe just sit tight and rent? So that's my goal here on this channel. So the first thing we do on a daily basis is we go over where mortgage rates are, then the economic data that feeds into all these equations. So without further ado, let's get over to it. So the first thing we do is we go over mortgage rates. These are the top 6 products people use when they're buying their first house. These are not my rates. These are not any individual mortgage rate company's rates. What this is a survey done by Mortgage News Daily, and they do a fantastic job. And they surveyed lenders all over the country, and they asked them these 5 questions. If you had somebody looking to buy their first house, it was their primary home and a single family home. If that's you, you're like, okay, good. Okay, those are my rates. But also they have a 740 credit score and they're putting down 20%. Is that you? Well, then most likely that's what your mortgage rate's going to look like. But if that's not you, what kind of interest rate would you be looking at? Well, I'm going to give you my information at the end of this video so I can help you figure that one out. Okay, but what we try to understand or help you understand on a daily basis is how does this all come about? Well, it's economic data. Remember the Federal Reserve at every meeting, they said, we're going to look at the economic data to figure out what we're going to do with interest rates. And the higher they pushed up interest rates, the more unaffordable houses became. So now what we're looking to do is have them push down rates so they can make housing a little more affordable. So what we look at is the economic calendar for the week. So this week, today, we really have, the only thing we have is the manufacturing numbers. That went from 49 last reading, was expected to come down to 48. It dropped all the way down to 47. It's showing there's some weakness in the manufacturing market. That's kind of probably furlough over to the jobs market, and you're gonna start seeing some little cracks in the economic foundation of our economy right now. I won't go over the rest of this data because today I want to really explain to you guys what we do on this channel. These are for the newbies, okay? So we take the economic data, we take the economic news, we take news from the Fed and try to extrapolate that out to give you an idea of what's going to go on with real estate. Okay, let me take you a deep dive into this. First thing we want to do is go over to the stock market. What's the stock market doing? Well, per CNBC, stocks are falling to start the 2024 year. Reason being is the rates are up a little bit and Apple slides, okay? But what I want you to understand is right through here. Stocks are falling on Tuesday, first trading day of the year, as interest rates rebound slightly and investors took some money off the table from a surprisingly strong 2023 from the S&P up 24%. Did your YouTuber, did your mainstream media person tell you the stock market's going to crash as well and the housing market's going to crash? If they told you those two things and you're still following them, I suggest you turn the channel because they're missing the boat, folks. So we're seeing the Dow Jones, the stock market actually rallied. A lot of people didn't sell at the end of the year. Why? Capital gains reasons, and they want to only sell their losses at the end of the year. They want to push over their profits so they don't have to pay taxes on it this year. So a lot of people furloughed selling their stocks into the new year, and now some people are going to start selling stocks as well as bonds, folks. So bonds are also like an investment. Okay, bonds actually, the mortgage-backed security bond is the biggest component of the mortgage rates. And I'm going to go over that in a second. But the next thing I want to go over is the CME. What in the heck is the Federal Reserve going to do this year? So what we watch on this channel is the CME FedWatch tool. This is from the Chicago Mercantile Exchange. What exactly this is what's the likelihood the Federal Reserve will change the federal funds target rate at the next meeting? Okay, what you have to understand right now is the federal funds rate is 5.25 to 5.5. Okay, the reason why I want you to understand that is because of this. This is what's called the dot plot. You're going to hear more and more about this on Wall Street and throughout the media. Okay, what this is, and I'll get my head out of the way. This is actually a charting board that 4 times a year when the Federal Reserve meets, all the members actually put a dot on where they expect the federal funds rate. Okay, right now the federal funds rate in 2023, it ended at 5.25 to 5.5 that you're seeing right through here. Okay, what do they expect in 2024? Well, those numbers are all over the board. Okay, some members say they're going to stay right where they are. Other members say they're going to drop all the way down here to, what is that, 3.75 to 4%. So this is where all the members are voting. The majority of the members are voting right through here. So they're expecting rates to be between 4.5 and maybe 4.75. Okay, we're 5.25 to 5.5 now. So that means rates are going to drop, from 5.5, let's say, to 4.5. So let's say 1 4%. That's right about in the range that they're telling us, or right through there. So a drop in interest rates. Okay, then you extrapolate that out to 2025, 2026, in 2027, out there longer. Okay, they're telling us that they're going to continue to go down and down and down. So I think we've basically seen the peak of interest rates. Okay, so now what you need to understand is another component of this. What's going on with inventory? So the part of the equation when it comes to housing market and the housing strength of the housing market is how many units are out there, what the prices are doing, and the availability of mortgages and mortgage rates, where those interest rates are, because that also affects housing affordability. Well, one of the big pieces of the puzzle is supply. And you hear people say all the time, guys, there is a shortage. And a lot of people are saying, no, there's no shortage. That's a farce. Well, here, if you go back, went back 25 years, United States total housing inventory. You're seeing that right up through there. Let's see where this is coming from. Trading economics. So this is basically trading economics, the United States housing inventory. Here's where inventory is, folks. Have you seen a time in history over the last 25 years that it's been any lower? No. So you don't have the housing units on the market. So what that's telling me, just that alone, the housing market's going to be basically, it's either going to rally huge in prices because there's just a limited supply and a lot of people are looking to buy. It's going to push out prices. But because of where rates are, you're not having as many people in the market to buy. So basically, you're just seeing a complete flat housing market. There's enough supply to fill the demand that's out there. Well, if supply continues to go down and rates start to come down, making home affordability a little bit more, you're going to have a rush back to the housing market. And will it be FOMO again in 2024? Time's going to tell. So without further ado, let's get over to the news that we have today and how that's affecting the markets. And today, right now, at this moment, we're going to talk about mortgage rates. So for the newbies out there, I want you to understand how mortgage rates are created. Okay, mortgage rates are created, it's not by the Fed, it's not by, the bank saying, okay, here's where the rates are going to be. It's figured out by a mortgage bond, and it's right through here. It's the MBS. This is a mortgage-backed security. It's a bond that trades on Wall Street. Its yield is the biggest component of your mortgage rate. Okay, so what we follow here on a daily basis is right there. This is the price of the bond. Okay, all you need to know is this. If the price of the bond is down, yields are going up. So that means rates are going up. So if the price is down, interest rates are going up. So we love when the prices are going up. Look back from November where we are today. Huge rally. So what we're seeing again, you go back to the CNBC markets, what people are doing right now, a lot of people, investors, are taking some money off the table. So they're selling assets, they're selling stocks and bonds. What does that do to the mortgage bonds? Well, if you sell enough mortgage bonds, you're going to drive the prices down and rates up. So that's my expectations right now with mortgage rates, because you had this bond go from all the way down here at 96 all the way up here to 100 and what is that, 1. It's a huge rally, folks. So a lot of people are actually taking positions off right now, cashing in. So mortgage rates are going to be a little bit kind of wishy-washy for the next couple of days, but I'm basically saying that they're going to be stagnant here coming up, and it's going to be completely data dependent, as the Federal Reserve states as well. So that's my report for today. But if you're out there and you're like, Dan, who in the heck are you? What do you do? You said at the beginning of the video you'd help us to figure out what kind of interest rate we would qualify for. Great question. My name is Dan Frio. I do this on a daily basis. I'm licensed in all 50 states and I'm a mortgage advisor. So if you're out there trying to figure out, is it a good time to buy in 2024? Maybe I can help you. Maybe I can at least guide you through the financials of this. Do you have enough money to buy a house? Do you make enough income to buy a house? Is your credit good enough to buy a house in this market? If you're uncertain about those, please reach out to us. I'd love to help you. How do you do that? Well, 3 ways. 1, you can hit the Apply Now button right there. It'll launch off to a little system that asks you a few questions so we can set you up with a mortgage advisor that specializes in exactly what you're looking for. Or if you scroll down to the bottom of my website, you're going to see a bunch of blogs and other tools and mortgage calculators. What you're going to see at the bottom of this is our 800 number as well as my email address. And guys, yes, it is my email address and I will be responding. If I haven't responded to you from an email from last week, I did take a few days off and I'm playing catch up right now. So I promise you I'll be back with you within the next 24 hours to answer any questions that you did have. So here's our number, there's my email address, and that's it for today, folks. So thank you so much for watching. God bless. Have a fantastic day. I'll see you tomorrow. Bye-bye.